Hey everybody, Marty Mazur. Good morning, March 29th, 2017. Your weekly video. The chart in front of you has to look familiar. Once again, it's the daily S&P 500 chart over the last 20 years with the 200-day moving average layered on top. As I've been discussing with you a lot of late, moving averages are good trend indicators, both the short and the longer term ones. 200-day is arguably, if not the most, one of the most used long-term trend indicators among technical analysts. When it rolls over and rolls over decisively, you got problems. As you can see, it did. The price dropped below, average rolled over, dot-com bubble burst, and we had a big bear market. Same thing, mortgage bubble, big bear market. So we can see when we zero in on those two areas, you see that 200-day rolling over, and again, the price below says very ominous things about the potential going forward. But if you just fast forward a little bit, it doesn't always mean that things have to roll over into big bad bear markets. Look at this one and look at this one. Very similar look. I got to imagine so soon after experiencing the worst recession, if you will, worst bear market in 100 years, this had to make people very, very nervous. And obviously in that 10% correction in 2011, there was a lot of selling. But for us long-term patient investors, as it turned out, it was volatility to ignore. People could have gotten in big trouble if they sold at the wrong time here. And then you move up. We had a very nice run, tested the 200-day a few times, and then in mid to late 2015, we finally had another 10% correction. And then when 2016 got underway, which was the worst start to a year in history, we had a look that looked very much like this look here, maybe not descending quite as much. But after two back-to-back corrections, that look had to have people afraid. But we didn't, once again, we did not roll over into a massive bear market. Once again, volatility to ignore. And here we sit today with a very constructive look in the 200-day and where the price is currently trading. So now we have to say, well, it's such a great indicator, but it could have got people in trouble here. What do we do now? Well, we look for other things that were characteristic here, but not so here. One would be very stark, and that would be the fact that we were in recession both of these times. It's been my direct experience and my observation in terms of my studies of market history that big bad bear markets tend to need recessions to occur. And sure enough, we got one here after the dot-com burst. They say this was the worst recession since the Great Depression when the real estate and mortgage bubble burst here. So easy. All we have to do is decide whether or not we're in a recession when the 200-day rolls over. And if we are, we take defensive measures, if you will. And if we're not, we just stay the course. Problem, folks, is that we didn't know we were in a recession here and here. Recessions are things we know in retrospect when the National Bureau of Economic Research tells us after all the data has come in and they've averaged it out and so forth, yep, we were contracting. Well, we wouldn't have known right in here that we were in a recession, so we might have thought it's just, garden variety, once in a while volatility that we shouldn't pay attention to. So really it didn't help us because, I'll say it again, it only helps us after the fact. And then, of course, it's no help if we were going to get defensive in here. So what else can we look at? Well, I pay a lot of attention to interest rates. Here's the yield on the 10-year Treasury. It was 6.79 when it peaked before this recession. It was 5.29 here. 3.73, yes, peaking, but from such a low level, I don't know that that would have been a big worry. These are historically below average interest rates on the 10-year. And then when we got into these two corrections, it was only 2.48%. Sits today at 2.41 after peaking at about 2.6. So historically speaking, these are not problematic interest rates. This one is questionable. This one is, at least in recent history. So we had higher rates on the Treasury. Fed funds, we recently got a quarter-point increase. We had 17 increases going into the mortgage recession, mortgage spot recession, if you will, and we had 7 going into the dot-com bubble. My experience, once again, is that recessions tend to happen after the Fed has gone through an extended cycle of tightening. Again, 17 rate hikes here. 5.25, 6.50, 0.25 upper bound when we had that correction, 0.25 there. This happens to be about as accommodative as the U.S. Fed could possibly get in terms of the Fed funds rate. Again, we've had 3 increases, but we're now just at the rate where this real massive tightening cycle actually just began. So very different look at the prime rate, of course, which tracks the Fed funds rate about 3% higher, 9.5%, 8.25%, 3.25%, 3.25%, 4% now. Not a lot of stress as it relates to interest rates or the cost of money. Mortgage rates, 8.38%, 6.42% before these 2 recessions, a historically low 5.2 or 5.19, very low 4.27 here, 4.02 as we sit here today. So the cost of mortgage debt, not problematic for the economy historically speaking. Getting into perhaps more tangible economic data, when companies are hiring, we know the economy is in good shape. Here we had a trend beginning about a year before this recession that was quite dramatic. Lower highs, lower lows in non-farm payrolls. Here we are a couple of years going into the mortgage bust. Lower highs, lower lows. Going into this correction, one could argue that we had a pretty good look, at least it was improving coming out of the recession. Here you can argue that, yeah, I see lower highs, I see maybe a downward trend, although we weren't seeing lower lows right in here, leading into these 2 corrections. And then since then, the jobs picture has improved. If there's any ambiguity there, there's none whatsoever when we look at weekly jobless claims, people filing first-time unemployment claims. We don't even really think much about it until it's above 300,000. We've had the longest stretch of below 300,000 since the early to mid-70s. And by the way, folks, there was only 210 million people living in the U.S. then. There's over 330 million now, and this is not adjusted for population. So very strong labor market today relative to what we had here. You see jobless claims going up, going into this recession. They were above 300,000 the whole time. Here we are spiking up going into this recession. We did get a little spike. We're at about 265,000 this last week, but again, a long ways from the 300,000. As you can see, we can live above there for quite some time and really not have problems for the market. So this is a very supportive trend that says very good things about the economy and the market. So you can see during these corrections, we had a declining slope. Very different than the looks here before these big corrections or big bear markets. St. Louis Fed Financial Stress Index takes into account high yield credit spreads and a whole host of other economic indicators. When it's above 0, it suggests that there is unusual or somewhat dangerous stress in the financial system that we should be thinking about. You can see where it was above 0 the entire time here in the second half of the 90s. Here we see it spiking up before the last Great Recession, and here we are today, actually the slope down. So again, very different look in the St. Louis Fed Stress Index here and here versus when we had real problems in the market. Historically speaking, you almost never get a recession without the yield curve inverting first. And what that means in my yield curve here, it's the 10 versus the 2-year Treasury. When the yield on the 10-year Treasury drops below the very short-term 2-year Treasury, that says very ominous things about the prospects for the economy. And sure enough, it inverted before this recession and inverted dramatically before this one. Here we are today. I remember people getting nervous here. I was illustrating here on the blog that we are a long ways from 0. Here you can see it coming back up, consolidating a little bit. If the economy is getting better, we should see both short and longer term rates rise, but we should not see an inversion. And when we ultimately do, that's something we're going to take seriously in terms of our asset allocation within portfolios. The consumer confidence. Remember, the consumer is 2/3 of the U.S. economy. These are the 3 major indicators that we track: University of Michigan Sentiment Index, the Conference Board Confidence Index, and the weekly Bloomberg Consumer Comfort Index. This one here came out day before yesterday. It was dramatically above economists' expectation. This one, the University of Michigan, will be coming out soon. We'll see if we'll get a pick back up there. And then the Bloomberg Comfort Index has been very robust of late. All 3 are at or very near their highs for the current expansion. Laura Ingalls Wilder once said, "It does not so much matter what happens, it's what one does when it happens that really counts." And that is true, and that's how we all think. But I want to bring in Mark Ritchie, famed, in my world, commodities trader, in an interview for the Market Wizard series. In order to score the really large gains, you've got to be willing to see those gains erode significantly before getting out of the market. So what Mark is saying is sometimes you do nothing. He can't see any other way. If you get too careful about not risking your gains, you're not going to be able to extract a large profit. So if you're in here and you have some nice gains and you see some things beginning to develop, you have to look at the macro. You have to look at the weight of the evidence to determine if that's something you should react to. Clearly here, a defensive posture made sense. And here, in retrospect, we know that it didn't, as it didn't in 2013 with a 29% gain. We had 13 drawdowns, one here 7.5%, which were quite alarming to a lot of people. But here we had the 50 and the 200-day moving averages telling us not to change course, and it was a good idea not to. So folks, obviously what I'm doing is I'm getting you prepared for the inevitable, which is volatility. I'll be here each week with the video and several times during the week with other commentaries helping you put it all into perspective. Thank you as always for watching and listening. In the next 2 or 3 days I'll have the weekly message. Take care. Bye-bye.